Welcome to Cryptonomics.
What drives the price of Bitcoin? Is it affected by other markets, such as the US stock market? And how can you use this information to your advantage?
In today's episode, we dive into these questions and much more. Bitcoin is a very polarizing subject. Either you're blown away by the endless possibilities of blockchain and cryptocurrencies, or you're very skeptical to it. Some even argue that it's a fad and compared to the tulip mania of the Dutch Golden Age.
No matter which side of this debate you find yourself on, we will list 3 big drivers that has led to the price of Bitcoin skyrocketing the last year, making it the fastest growing asset ever.
But first, what do we mean when we say something drives the price? There are many ways to look at this, but a popular tool is looking at the correlation.
In finance, the correlation measures the degree to which two securities' price are related to each other. The correlation coefficient measures from -1 to 1. -1 means that the correlation is negative, so the prices moves in opposite directions. If the price of one asset goes up by $1, the other one will go down with $1.
A correlation of 1 means that assets move in a correlation with each other. So if one asset goes up, the other does too. And a correlation of 0 means they move interdependently of one another. So if one goes up, the other might go down, might go up, might go wherever.
Now, assets are almost never perfectly correlated or uncorrelated, but there are still a lot of factors that drives the price increase in Bitcoin.
Obviously, demand is the #1 reason for why Bitcoin prices have skyrocketed. Whether you think that Bitcoin is reaching a point for mass adoption or is driven by speculators who want to get rich quick, an increase in demand when there's a limited supply will increase the price.
The mysterious creator of Bitcoin, Satoshi Nakamoto, designed Bitcoin to have similar properties to gold, so thus it has a limited supply. The maximum amount of Bitcoins can never exceed 21 million coins.
Currently, the reward for discovering a new block when mining is 12.5 Bitcoin. And this halves every 210,000 blocks.
What this actually means is that at the moment, Bitcoin is actually experiencing an inflation of approximately 4% per year up until 2020. This is a relatively high inflation, especially compared to some fiat currencies like the American dollar.
However, when the 21 millionth Bitcoin is mined, Bitcoin will reach a permanent deflationary state. This is because Bitcoin will get lost. Currently, around 16 million Bitcoin has been mined, but it is estimated that about 4 million Bitcoins has been lost due to password hacks, exchange hacks, or faulty hard drives.
How does all this relate to the price of Bitcoin? Well, since we know the exact supply of Bitcoin, the key driver here is the demand. And how do we measure demand?
Nowadays, most people have heard of Bitcoin, even your mom or grandpa, but still a very low number of the population actually uses Bitcoin or owns it.
Since Bitcoin often doesn't trade on the same exchange that you might be using for buying stocks or bonds or funds, we know that people have to look for websites trading Bitcoin. And where do we turn when we are trying to find something on the web? Well, Google search.
When new investors want to buy Bitcoin, they're highly likely to search for terms like Bitcoin, how to buy Bitcoin, or Bitcoin prices. In general, a spike in these search terms have a correlation with an increase in price of Bitcoin, and this can easily be monitored through Google Trends.
No other asset has grown as rapidly in 7.5 years as Bitcoin. From the day it started trading in June 2009 to December 2017, the price has risen by more than 4 million%.
This rapid growth has increased the interest in Bitcoin dramatically, exponentially growing the user base during 2017. One of the biggest exchanges, Coinbase, has doubled their user base during 2017 from about 5 million in January to more than 13 million at the end of November.
This growth in user base, the limited supply of Bitcoin, and a widespread buy and hold mentality introduces an artificially low liquidity in the Bitcoin market, which increases volatility.
Basically, there isn't enough Bitcoin to go around.
And when volatility is high and people want in, well, the price will skyrocket.
In countries suffering from geopolitical and financial turmoil, there has been a tendency for Bitcoin prices to spike as these citizens want to preserve their wealth.
This could be seen during the Cyprus banking crisis, when the government seized citizens' funds. Similar flows into Bitcoin could be seen during 2015, when we had the troubles in Greece, and now most recently in Venezuela.
This was also seen in the Brexit referendum in 2016. In June 2016, Bitcoin prices surged as the British sterling fell. During a 2-month period between May and July 2016, Bitcoin prices surged 65%, while the sterling dropped 10%.
Now, historically, the number one asset for preserving wealth has been gold. Gold is also an asset with a fixed supply and serves as a way to avoid inflation. But how easy is it to buy gold when you live in Venezuela? Overall, gold is a hassle to deal with. It's heavy, it's hard to move around, and it's also very hard to trade for a fiat currency of your choice when you want to buy a pizza.
Bitcoin solves all these problems while still being a scarce resource. But how does it correlate with gold? And how does it work as a diversification against the stock market?
First off, looking at the correlation between the major stock market indices like the S&P 500, the Eurostoxx 500, or Hang Seng in Hong Kong, China. Not surprisingly, Bitcoin is not closely correlated with these markets, varying up and down between the years in the time series. This tells us that Bitcoin could potentially be an asset for someone who wants to diversify from the stock market.
When it comes to gold, Bitcoin and gold have historically had a very low correlation. What is interesting to note is during last year and this year, the correlation between gold and Bitcoin has increased. The correlation has increased by almost 15 units. This could mark a new trend for wealth preservation. Most likely, this data will be more interesting following a financial crisis, because you have to remember that Bitcoin came in the waters of the 2008 financial crisis. So the data isn't really interesting enough to build an investment case on.
Yet. Regulations from governments also tend to have a big effect on the price of Bitcoin. Each time a government announces a regulation of Bitcoin or cryptocurrencies, the price will be affected in some way.
After Japan in 2017 announced that Bitcoin will be considered a legal tender, the price of Bitcoin surged 160% in just 2 months.
And in China, when they banned the cryptocurrency exchanges and the ICOs, the initial coin offering, Bitcoin plummeted 29% in just 24 hours.
Regulation within Bitcoin also affect the prices. This could be seen in the summer of 2017 with a hard fork into Bitcoin Cash, which resulted in a stalemate of the Bitcoin prices for weeks leading up into the vote of the actual hard fork.
Even though Bitcoin is a decentralized global network, the national regulations and internal conflicts in the blockchain community will have a big impact on the price of Bitcoin.
So we also want to find out if there were any correlation between Bitcoin and other cryptocurrencies.
Historically, the correlation has been low between the big players like Bitcoin, Ethereum, Dash, and Ripple. Last year, it was even slightly negative, but this year, the correlation has risen higher than ever before. The increase in correlation can especially be seen between cryptocurrencies with a similar objective, like Bitcoin and Litecoin. So why is this happening?
First of all, big money is entering the market, and big money like hedge fund or other institutional investors are more likely to spread their bets through plain old diversification than betting on one single case.
Secondly, we have the crypto whales, early investors in the crypto space who have seen huge returns on their investments. These whales are focusing on divesting their earlier investments into other cryptocurrencies. And this leads to an increased flow into altcoins.
This is because instead of cashing out their returns and having to pay a large capital gains tax, they would rather invest these returns into other promising projects to potentially earn even more returns.
Last but not least, we have a lot of new investors flooding the markets. They have heard of the tremendous returns on Bitcoin, but they think they missed out on the rally, so they're looking for the next big thing. This is of course also one of the reasons why we've seen so many shady ICOs.
So, what is the main conclusion we can draw from this?
Even though there are a lot of Bitcoin purists or all-in investors in Bitcoin, most people are not. We
can see that Bitcoin most likely can hold a dedicated spot in most people's portfolios as a way to diversify against stocks, bonds, commodities, and real assets that most people already hold in their portfolio.
All this just ensures that Bitcoins and cryptocurrencies in general are here to stay.
If you like this video, please hit the subscribe button, leave a comment, and give us a like.
Take care.
See you next time.